Right, good afternoon, everybody, and thank you for joining the Accordance webinar today when we're going to be looking at the 4 quick fixes. So with me today, I've got 2 of my colleagues. We've got Andy Spencer, who's our Director of Professional Services, and we've got Aniko Tooth, who's one of our VAT consultants. So the purpose of today is to give a bit of a quick guide, because it's quite detailed, to the quick fixes that are coming into place. So the agenda we've got set out is just to have a talk about what are the quick fixes and why are they coming into play, to look at the details of each of them in turn. And then at the end, we're going to have a live Q&A session where if you've got any questions, you can answer them, and we'll have a very good go at answering back for you. So we'll see how it goes. What I would say just quickly is a few housekeeping points before we get going. So the first one is that everyone who's attending today, we will send you a copy of the recording and the slides after we've finished. And the webinar will then be on our website, so anyone who you know couldn't attend, they can come and have a look at it and listen afterwards. If any of you want to drop questions through as we go along the webinar today, please do so. We will try to answer them, but if not, we'll come around to it at the end. And also, as a final housekeeping point, is that we would like you to take part and be a bit interactive today. And so we've got a few polls that are going to appear throughout the afternoon. If you could help us by answering the questions, and everyone can see people's views on the quick fixes and what the challenges might be, I think it'd be really useful for everyone. And with that in mind, just before we get started, I did have a first poll question to ask. And it will pop up in your screen in a moment. But the question is, how prepared do you think your business is for the changes associated with the VAT quick fixes? So you've got a couple of options there. And if you can have a look through them. So are you ready for them? Ready for some, or not ready at all? Okay. And so... And here the results are, so they've come through. So, so it looks a good idea that lots of people are on this webinar, basically. So 6% are ready, 46% a little bit ready, and about the same again, not ready. So hopefully today will be a really useful session for everybody to get some information on what's going to be happening and start making plans and know where they're going to go with it. So let's kick off with the first part of the webinar then. So what exactly are the quick fixes? Well, I guess it's probably true to say that I think they've been a little bit under the radar, to be perfectly honest, at least in the UK, maybe a little bit more on the continent. Maybe that's because of Brexit. I'm not sure. That's been all-consuming for lots of people, but we're now not too far away from them happening. The quick fixes are basically that they're a step on the EU's pathway towards modernising the VAT system, what they like to call the EU Action Plan. And this was all started to put in place in 2016, but it's been a path we've on since really 1993. So when the VAT system came into force then, as it was meant to be an origin-based system, but we started in a transitional situation. We're still in that transitional situation now, 25 years plus along the way, and we're now sort of about turned and going towards a destination system. So the quick fixes are here to help with that, and they're all changes related to B2B supplies of goods that are moving cross-border in the EU. So looking at the slide, so when do the quick fixes have effect? So they come into effect on the 1st of January 2020, so just a little over 5 months away, and they will stay in effect for, well, it's anticipated for a limited time period of 2.5 years until July 2022, because that's when there are proposals set out for a new definitive VAT system to be introduced. Now that's still a proposal, and we don't know if that's going to happen at the moment, but we will wait and see, and that's what we're going on. what's going to be impacted? So there are 4 specific areas impacted by the quick fixes. These are call-off stock arrangements, they are chain transactions, they are the conditions to exempt B2B intra-EU movements of goods, and also the evidence that is required to support that movement and the exemption. And why are the changes? Why are the quick fixes being brought in? Well, it's basically a short-term solution to address some serious issues in the EU, which, you know, specifically relate to VAT fraud and the VAT gap. So it's bandied around in the press a lot that there's a VAT gap of 150 billion euros in the EU, and about a third of that, so 50 billion, relates to VAT fraud. And plenty of that fraud relates to missing trader intra-community fraud, which is where goods are moving cross-border. There's lots of exemptions, there's lots of cash in the system, and member states losing the money. So hopefully these quick fixes will go some way to resolving that. What's also worth saying is just having a think about why the EU's doing this. I think the EU's got the best intentions going ahead with these changes. I've been to lots of conferences and spoken to the EU about why they're doing it, and they do really want to make the situation easier for everybody, to make it, to simplify the situations and to give a bit of harmony on what's been realistically quite a difficult area of law for people to practice and to implement. But I think what you're going to see, and what will come through and we'll talk about, is that even though they've tried to do that, it might be that we've got a little bit of a road bump coming in the road. I looked up before we started this what the Cambridge Dictionary says about a quick fix, and it says it's something that seems to be a fast and easy solution to a problem, but it is in fact not very good, or will not last very long. And I think there's a degree of truth in that. There's a degree of truth in what the EU's saying, that it will make things better. But I think it will be a case of wait and see. And we can talk about that in the Q&A at the end of the session. So, just before we get started on the first quick fix that my colleague Annika is going to talk about, just had one more poll question. Just based on what I've said, do you think the quick fixes are a good idea? And do you think they will make VAT compliance management easier? So 2 questions, yes and yes, yes but no for the second bit, or a definitive no for both of them. And just give you a little bit of time to answer that. Okay, a couple more seconds. And let's see what the answers were. Here they go. Okay, so there we go. So we do think they're a good idea, but are they going to make compliance management easier? Probably not. So I guess that kind of that's the majority of people saying that. We've got a quite a high percentage also saying no and no as well. So I think on the whole, people don't look to be too keen about this. So again, hopefully today will shed some more light and give some clarity, and then that will make things easier going forward. So I'm going to hand over now to Annika, who's going to talk about the first quick fix, which is related to call-off stock.
Welcome everyone. As Rob mentioned, the quick fixes try to solve a few things on the short run, and the first one that I'm going to talk about is related to the call of stock arrangement. So in this picture you can see what's happening regarding this arrangement. It's basically that there is a supplier established in one EU member state who moves its own goods, its own stock, to another EU member state, to a warehouse, which is basically located in the same country as the customer of the supplier. And why can this be a good feasible solution? For example, in the automotive industry, the customers usually work with a very short time frame to be able to procure equipment or different kinds of tools. And it would be quite useful for the customer to actually just go to the warehouse and get access to any of the goods that is needed for production, for manufacturing, instead of, say, placing an order to a supplier who is in a different member member state, waiting for the order to be accepted or the transportation. So it's quite efficient from that point of view. However, if we move on to the next slide, we can see that the current position is quite challenging for the businesses, because basically the supplier would end up, as a result of the movement of its own goods from one member state to the other, holding stock in the member state of arrival. And in this member state, the supplier is not established. However, it already knows the identity of the customer. So it knows who the goods will be sold to in that country where the warehouse is and where the goods are eventually moved and arrived. And while the goods are staying in this warehouse, there is no ownership shift. So basically, the goods will remain in the property of the supplier, even though they move from one country to the other one. And from a VAT perspective, this can be a challenging thing, because for the supplier, what it means from VAT normally is that there is an intra-community movement of goods. So the supplier basically carries out an intra-community supply of goods from the member state of dispatch to the member state of arrival. And also the supplier is deemed to be carry out an acquisition, an intra-community acquisition of goods. And what that means is that the supplier will need to account for the acquisition tax for the movement of its own goods, even though it didn't sell it to any customer. And the acquisition tax would require also the supplier to actually have a VAT registration obligation. And if there is any sales following that transaction, that would be subject to the scope of the local tax, which would be either taxed by the tax of the destination to the arrival member state, or it might be the case that it would fall under reverse charge, which basically means that the customer would be accounting for the VAT. However, the point is that the fact that the supplier moves its own goods from one member state to another member state would initiate a VAT registration for the supplier. And in order to avoid this, to have two different transactions, first a movement of own goods, and second a local sales, some member states already introduced a simplification, and this is what we basically call a call of stock simplification, a call of stock arrangement. And with this arrangement, the idea is to so that the supplier can avoid any VAT registration in the member state of arrival. Moving on to the next slide, we can see the exact challenges. As I mentioned, only some member states introduced this. So this is one of the problems that first of all, the businesses that are looking into applying an arrangement like this, they will first have to check on a member state by member state basis whether this is actually something that is implemented by the country. And even though it is implemented in some of the member states, there are differences in the approaches that the member states take. So there are different rules even in those member states where the call of stock simplification might be applicable. We listed a few examples to understand why this can be challenging for the businesses. As I mentioned, there needs to be an analysis carried out in order to understand how the member state, whether the member state implemented the simplification or not, and under what conditions it can be allowed. And secondly, there are some specific examples as well that currently the member states' interpretation tends to differ. One of them is, for example, the treatment of the warehouse where the goods are moved into. So in some member states, there is a requirement that it needs to be rented by the customer, while in other member states, it can be the case that it actually needs to be owned by the customer. And it's also not quite clear clear how long the goods can be stored in that warehouse. In other words, how much time the supplier has to actually sell these goods to the predetermined customer that it has in that member state. And finally, it's not clear, or there are differing interpretations as to how to treat if there is any kind of loss or damage regarding the goods that are stored in the warehouse. So this can create a problem, along with the fact whether the idea that the supplier holds goods in a country where it has absolutely no VAT presence, whether that initiates any kind of establishment for the supplier. And since the member states took different approaches to these problems, to these issues, it can be right now quite challenging for businesses to understand the differences in the applied practices. And that is basically the reason that the quick fix related to the call of stock is being introduced. And we can see it on the next slide, how it aims to clarify the situation. First of all, it introduces a definition for the call of stock, saying that the transfer by a taxable person of goods forming part of his business assets to another member state under call of stock arrangements shall not be treated as a supply of goods for consideration. What does it mean? Basically, it means that, as I mentioned originally, there are two transactions. The first one is when the supplier moves the goods, its own goods, from one member state to the other member state. And second one is when it actually sells it to the predetermined customer. To make it simpler, to make it one transaction, and to let the supplier avoid the VAT registration, this definition lets the supplier to treat the first transaction, that is, the movement of its goods, as if nothing happens in VAT, up until the point that the customer goes and picks up the goods in the warehouse and actually takes them away and pays for it. So basically, there would be no intra-community supply and acquisition carried out by the supplier as long as the call of stock simplification can be applied. However, there are, of course, requirements for this. First of all, these goods need to be transported by the supplier. It can be also a third party on his behalf, but the goods need to be transported by the supplier, and they need to go to the member state where where they are known to be sold to the taxable person customer at a later stage. And it's very important also that the parties, the supplier and the customer, they conclude an agreement on this in advance on the application of this simplification. It's also important that the supplier cannot have a fixed establishment in the member state of arrival. It makes sense because the whole idea of the simplification is to let the supplier avoid any kind of VAT registration in the member state of arrival. So obviously it wouldn't make much sense if it already had that presence there. And accordingly, the customer needs to be a taxable person, and it needs to be VAT registered in the member state of arrival, so where the warehouse is. And this is because the customer will have to account for the VAT. This is how the simplification basically works. And the supplier, of course, needs to be aware of the customer's identity. It's a predetermined customer, so the supplier already needs to know who is going to sell the goods when the goods are moving to the other country. And this means information about the customer and its VAT number issued by the member state where the goods are going. Finally, there is reporting obligation related to the application of the call of stock as well, and that is the requirement to submit a recapitulative, so-called recap statement, which is also called as intra-community sales list. And this is basically about documenting the transactions. This is a separate report to the VAT return, and in this report it should be indicated all the details of the transaction, invoice date, VAT number of the customer, name of the customer, and basically the identity of the customer needs to be indicated in this one. So these are the main requirements necessary to apply a call of stock simplification. And moving on to the next slide. I was talking about the time frame earlier, that it was not quite clear what is the required time frame for the supplier that it has to sell all the goods from the warehouse. Is there any time frame at all? The member states have differing opinion on this currently, but with the quick fix, we can have clarity on this issue. Basically, there are 3 rules related to the time frame. The first one is if the goods arrive to the warehouse, the supplier basically has 1 year to sell them. And if the goods are still there and they don't get to be sold, then there would be a deemed supply following, but basically on the next day after this period expires. So this rule basically sets out the time frame for 1 year that the supplier needs to sell the goods to its customer. The second rule is there is an exception to this, and that is the return of goods, which the quick fix also takes care of, saying that if the goods are returned within 12 months after they arrive at the warehouse and they are not sold, then it can be avoided that a deemed supply takes place. So the return of goods should be fine as long as the time frame is respected as well. And the last rule regarding the time frame is refers to a situation when the supplier is substituted by another taxable person. And here we also have the 12 months time frame. So if it happens within 12 months after the arrival of the goods, there wouldn't be a supply to take place in the member state of arrival. However, there are also requirements for this. So there is a change basically in the supplier. We are still within the 12 months deadline, and it also needs to be taken into consideration that the rest of the call of stock rules are still met. And also finally to make a proper record of this change in the supplier's records. So these are basically the conditions to avoid that there is a supply and the new supplier can just continue applying the call of stock simplification as long as all the rest of the rules are met. So in the next slide, we can see what we can take away from this. So we listed a few advantages and a few things that can be considered before a business is thinking about applying the call of stock or considering whether it would be a feasible option or not. First of all, obviously, with all the quick fixes, as Rob mentioned, they are to solve things on the short run. But the good part is that now businesses will not have to investigate every single member state's rules on certain issues, because there will be harmonized rules and it will be quite clear what these rules are. So this simplification will help businesses to understand whether this can be a feasible option or not. And on the other hand, existing VAT registrations might be reconsidered whether they are needed or not, because maybe they can be replaced by the call of stock simplification, and that would be a better option. And on the other hand, it would also be a good way to understand if maybe the business can expand to new countries without actually having to register and go for compliance costs, submitting returns, meeting with any other reporting requirements specific to that country. So it's quite good to consider what kind of activity the businesses have, whether the customers, whether this would be a good solution for the customers, depending on the specific field of business that we are talking about, and definitely reconsider and optimize the VAT registrations. On the other hand, obviously, there are still some definitions, some clarifications that are needed. As mentioned earlier, the member states have a little bit differing views on how the warehouses should be treated and what should be the conditions. To give another example, it's usually worth checking what kind of rights the supplier has within the warehouse, because usually the warehouse is maintained by the customer, but the goods inside are the suppliers. So whether the supplier can enter the warehouse, what kind of rights it has within the warehouse. These things are still not clear. So we see, as Rob mentioned, that there might be a little bit more clarification needed on these definitions. And secondly, and probably that is also part of the challenge, is that there are many requirements, and since the moment that one of these requirements are not met, the call of stock will not be applicable. It would basically mean that the businesses would have to find out internal policies or checks to be able to constantly monitor whether they are still in line with the requirements or not. This is also especially important in case of an audit, a tax audit, to be able to support that all the conditions met for the application of the call of stock. This is the case with all kinds of simplification and exemption in VAT, that there needs to be proper supporting documents behind. And to give a few more points on the limitations of the call of stock at the end, I'd like to know that, for example, it's not possible that the supplier moves the goods to the warehouse in the member state of the customer and then decides to sell the goods to any other customers. Same thing with the member state. The goods cannot be dispatched to any other member states. So the idea is that the supplier moves its goods to one EU country where it's not established, puts them in the warehouse, and then from the warehouse it already knows the customer, and that should be one single customer that it sells the goods in the warehouse with the conditions that were mentioned earlier. And also it's kind of a limitation of the call of stock that I mentioned, that it was not clear what happens with if, for example, there is a loss or there is a damage to the goods. And right now, based on the quick fixes, it seems that any kind of small loss would mean that the conditions of the call of stock would not be met anymore. So that is also something to consider when planning on applying this simplification for future or existing business ventures. So these were the main points to take away from the first quick fix. Now I'd like to give the word to Rob with the poll. Thank you.
Right, that's great. Thank you very much, Anniko, for that one. So obviously we've just been through some of the advantages and negatives of what the changes might mean for call-off stock. So our poll question here is, how do you perceive that this call-off stock quick fix, will it provide any of the following benefits to your business? Yes, will it make things easier? Or no, will it have no difference? So there'll be binary answers to choose from, but we'll see what we get. We'll just give you a couple of seconds to do that. And so let's see what we've got. Oh, very even. A marginal no, it will have no difference to the business. And I guess that could be because not everyone's got call-off stock arrangements, or it's good, but it's good to see that 43% of people think it will make things easier. So that would support what the EU was saying or what its aims were. Great stuff. Okay, so next we're going to move on to talk about chain transactions. And this will be my colleague, Andy Spencer, to guide you through it.
Thanks, Rob. So we're going to talk about the second quick fix, which is in relation to chain transactions. Now, chain transactions can be seen as something that are terrifying and creating lots of complexities, and that's why the EU has decided to try and provide some clarification. So a chain transaction is essentially where goods move through a party of businesses, so 3 or more parties, and they move directly from the first supplier in the chain to the final customer. And that those entities are in different member states. So where you've got a number of transactions in a chain where the goods are moving cross-border, the general principle is that only one of those transactions can benefit for the exemption available for intra-EU movements of goods. So that's commonly called the moving delivery. And what that creates is a situation where you've got one exempt transaction, and then you've got a number of taxable transactions either before the move in delivery or after the move in delivery. And if you've got supply chains and chain transactions involving 4, 5, 6 parties, that means that you can create a lot of transactions before or after the move in delivery, and they all have to be considered and the appropriate VAT treatment applied, and that can either be in the member state of dispatch or the member state of arrival. So it can be seen it can cause great complexities when considering the move in delivery, and that often leads to errors and a failure to register. There can also be confusion between the parties. So ideally, businesses, when they're involved in chain transactions, don't want to create new VAT registration obligations, and that's why the triangulation simplification was introduced when the single market was first created. So that's a solution to a typical chain transaction where there's parties in 3 member states and the goods move directly from one to another. So that avoids the need for the intermediary to be registered. But that doesn't always work. It won't always apply, in particular where there's only 2 member states involved. And the issue at the moment is that different member states can apply different interpretations as to determine the move in delivery. So that can lead to inconsistencies, and businesses have to assess each supply chain taking into account the rules in the member states involved. And there's been a number of VCJ cases, for example, Eurotires, which have looked at this, and depending on how the chain is characterised, there may be a need for additional registrations in additional member states. So that's the issues at the moment, and the quick fix is there to try to solve that. Firstly, I'd highlight that the quick fix is only in relation to transactions where we've got B organising the transport. So B is the intermediary party, and the quick fix only applies to that particular scenario. And I think the logic behind that is that the EU thinks that where A is doing the transport or where C is doing the transport, there's already clarity. Unfortunately, that's not always the case. So there still will be issues going forward. But where B is the intermediary party on organising the transport, the quick fix provides clarity in relation to how that should be treated. And what it says is that the transport shall be assigned the supply made to the intermediary. So that's the basic position. So in the diagram we've got here, we've got supplier A in member state 1, sells the goods to B, who then arranges the transport and provides A with a VAT number from member state 2 or any other member state. And then the move in delivery is A to B. So it's an exempt dispatch by A and then a taxable acquisition by B. B then makes a domestic sale in member state 2 and then has to account for VAT. Obviously needs to take into account extended reverse charge and other complications in relation to whether VAT should be charged, but that provides clarity that the move in delivery in this instance is A to B. So that's the default position, but what the quick fix does is give B flexibility. So the other option is that if B wants to choose to change the move in delivery so that it's from B to C, if they communicate a VAT number in member state 1 to the original supplier A, that means that that becomes the domestic supply. Then the move in delivery then becomes the transaction between B and C. That can be exempt, so there's no need for B to charge any VAT to C. And the reason why they might use this, B might use this, is because, for example, if he's already registered in member state 1, but not in member state 2, it would be beneficial to deal with the obligations under an existing VAT registration rather than having to create a new obligation in another country. So there's a couple of options which can be used. So it gives B some choice, but that will need to be considered and exercised, and it also potentially creates issues for A and C. So some of the points to consider, so the advantages, obviously, as I've mentioned, is that it gives certainty as to a particular type of chain transaction where B is organising the transport, and then gives B that flexibility so it can seek to manage its registrations and ensure that it's compliant. But there are some things that it doesn't do. It doesn't look at any chains involving non-EU countries. So, for example, if the goods are sourced in the EU and go outside the EU in a chain transaction, it doesn't consider that. It doesn't consider transactions the other way, where they're coming from outside the EU into the EU. It doesn't specifically deal with four-party triangulation. So that sounds like a sort of contradiction in terms, but four-party triangulation applies when you've got four parties rather than three, which applies in the traditional triangulation simplification. So the EU have responded to some of the criticisms of the quick fixes, which Rob will cover in more detail later. And they've said, interestingly, that they view that triangulation can apply in cases where there's four parties. But we know from practical experience that that's not possible in all countries. So it's potentially going to be the case that that four-party triangulation does extend so that it can be used when there's more than three parties in the supply chain. The key thing in all of this is to understand the position of the business in the chain and the rules that relate to that position. So if you're A, making sure that you know what your obligations are. If you're B, what are your obligations? And C, what are your obligations as well? So one of the key factors is making sure that you, as far as possible, understand the full supply chain. Because if you don't know all the parties and the choices that they've made, increasingly it's going to be difficult going forwards in order to be able to determine the appropriate VAT treatment and what your obligations are. There's also a need to make sure that you have got the underlying documentation, so contracts, transport documents, CMRs, etc. So our view is that this quick fix isn't going to make the issue of chain transactions go away, and there are still going to be lots of complications, but it does provide some clarity in relation to one specific type of chain transaction where B, the intermediary party, is responsible for organising the transport. So I'm now going to pass you over to Rob, who's going to ask you another poll question.
Okay, thanks a lot for that, Andy. So we've got another poll question. This one is based on a chain transaction. So it's a very straightforward one, like, do you get involved in chain transactions? And the reason we're asking is that we don't see so many within the UK, but lots and lots of occurrences in Europe. And just to the point why you ponder that question, I have seen some questions come in, and we will be answering them at the end of the session. So here we go with the answer. So there we go. A majority, just 60% of people are involved in chain transactions. So definitely something to think about here. They're always a tricky area, like Andy says, and these quick fix changes for that will definitely be something to look at. So we shall keep moving along with quick fixes. On to number 3 now. So number 3 is slightly linked to number 4, but they're separate, hence why we're looking at them separately. So this is about the mandatory use of VAT numbers. And the reason we've got the picture up there is that these come into play when you've got goods moving from one member state, which, as Anniko said, is called an intra-EU dispatch. And then you've got the goods moving to another member state, which is where you have acquisition tax to account for. And this is part of the transitional period we're still in, where instead of one transaction and one supply for VAT purposes, because there's only one movement of goods, we've actually got a dispatch and an acquisition to look at. So what is the current position for the use of VAT numbers? So at the moment, it's regulated by Article 138 of the VAT directive. And that says that the place of supply when you're moving goods is where they are dispatched from. And it says that if the supplier makes its supply to a taxable person in a member state other than that in which the transport of the goods begins, then it can exempt, or under UK terminology, zero rate, that supply. And that's really good. That's where it comes down to the goods are moving, you don't charge any VAT from the country of dispatch, and then the recipient of the supply just accounts for acquisition tax in the other country. In practice, most tax authorities do take this line, but they do add some additional conditions, and these are generally that they retain some evidence to show that the goods have been dispatched from the member state of departure. And also, and this is a really important point relating to the quick fixes, is that they ask the supplier to get a valid VAT number from the customer from a member state which is not the same as that where the goods are delivered to, and they ask that to be put on the invoice. So just as a change, because this is an important point, a quick poll question here is, how often do any of you verify your customer's VAT number when via using the EU system called devised? For those of you who aren't aware, devised is a system the EU runs that collates everybody's EU VAT number, but it's uploaded to by different member states. I'll give it a couple of seconds, just see where people are at the moment. So there we go, that's really good. 50, almost 2/3 of people do go and check the customer's VAT number every time on devised. We've got a few people who never, and a good portion of people who do it sometimes as well. There's another question we could ask, which is to say how many people print out that devised number and keep it on a file, but we won't do that one now, but it will become more important going forward. So what are the challenges of the current system? Why are they thinking about making the change? Well, the reason is that Article 138 is what we call a substantive conditions, and the other conditions the member states apply around getting hold of the recipient's VAT number and having evidence of the goods moving are what we call formal requirements. Now, there's been lots of cases heard at the ECJ where tax authorities have said that the exemption for cross-border movement of goods can't be applied if the supplier hasn't got the customer's VAT number. But the European Court of Justice has repeatedly said that as long as the substantive condition applies, and that's that the customer can be proved to be a taxable person, then it's enough to allow for exemption. Now, that is the reason, that's the main challenge. We picked out two of the main cases there, Joseph Pluckall. In that case, there was no VAT number for the customer, but he still won the case because he could prove he was a taxable person. And then there was also Eurotire. And in Eurotire, this is distinct from the Eurotire case that Andy talked about in chain transactions. This was where the customer was actually VAT registered, but he hadn't been put onto the devised system. So some countries you need to apply to be put on the devised system, even though you've got a domestic VAT number. So this is the real challenges that there are, and also the member states have got different interpretations of these rules. So basically businesses have uncertainty, and the point of the quick fixes is to give some certainty to businesses. So what are the new rules or rule going to be? So and the way they're doing it is by making a change to Article 138. So they're keeping the first part of that we've got at the moment, which is that the recipient should be a taxable person, acting as such in a member state other than that where the goods are dispatched from, and that is as you were. But then we're adding in two more conditions. The first one is that the recipient must have been identified for VAT purposes in a member state other than a member state of dispatch, and its VAT number must have been indicated to the supplier. And then a third substantive condition is that the supplier must have submitted a recapitulative statement, which is an EC sales list in UK jargon, that's got the correct information on it about the supply and the customer's identity. And really importantly, it's worth saying that the point in brackets there, which says if this is not the case, the supplier should justify a shortcoming to the local tax authority, is written in the law. So basically the law, the EU VAT directive, is already looking ahead to where there might be issues and problems, and in our view, trying to find a way around managing that. So basically, in short, the quick fix is looking to make a substantive condition of what's now a formal one. So what are the points to consider going forward with this one? Well, I think what's really good and an advantage is that there's now some very clear requirements on how intra-community supplies can be exempted, so there's no uncertainty across different member states, and that's going to be good for businesses. And I think it's also good, as we said, that the VAT directive is looking to deal with any issues such as the supplier being unable to comply with some of the requirements up front. However, that said, I think there are probably a few more problems being created rather than problems solved. So just as a point, I think this is probably going to be an administrative burden. So as a start, we had 57% of people on this webinar have actually checked the devised number all the time. Well, this is now going to be a requirement completely. So how is that going to be kept up to date? Who's going to be doing it all of the time? And secondly, there's now the need to do an EC sales list is something that's actually in law. So it's going to be really important for businesses to make sure their compliance all stacks up together, and the EC sales list that can sometimes be neglected a little bit are done, because otherwise you might not be able to exempt the supplies. There's another question around negatives in like what happens if you've got high volumes in your business. This is going to be quite burdensome to get all the information. And there's also, I think, a really key point, which is that because the EC sales list is a requirement for exemption, it actually means now that at the time you make your supply, you've got no certainty that you meet the conditions to apply that exemption. So you might do your dispatch, you say, I've got the VAT number and I know I'm going to do the EC sales list, so you don't apply VAT, but you can't be certain about that. Somebody might be ill, you might miss the EC sales list, something might happen. What's the situation there? And a few other things just to think about that aren't on the slide is that some countries you have to apply to be on the devised system. So in Spain, it's separate, you have to do it. Ireland's just introduced a new way of registering for VAT, that when you apply, you have to say, are you a domestic trader or an intra-community trader? So you have to make sure your business is on VISE as well. And then I guess for businesses, just to think, what are they going to do if they're nervous around meeting all of the conditions for exemption? Will it become a default for businesses to just charge VAT, because then at least they know they're safe? But that will put onus onto the customer to then have to be able to recover that VAT. And that's maybe not always normally allowed, but we would expect it to happen under the new rules. So lots of different things there to consider around the use of the VAT number. And finally, we'll just have a look at the last quick fix, and I'll carry on with this one because it's very similar and connected with the need for a VAT number. So again, this is looking at where goods move from country A, member state number 1, to member state number 2, but this is around the documentation that you have to have, and that we alluded to in the last slide. So as we can see on the next slide, the current position, as we've said, is that in order to do an exemption, you need to have some proof that the goods have moved cross-border. But what is a bit of a problem is that the VAT directive does not provide a specific guidance, but each different member state has its own local rules on it. So what does that mean in terms of the challenges we've got at the moment under that? Well, it means that you've got a problem that in each different member state, you have to look at the different pieces of evidence that are required. In a lot of the member states, it will be sufficient to have a CMR document, but then some member states need them to be stamped, some of them need to be signed. So if you are trading in all different 27 member states, you might need 27 different procedures in place. And it also creates a problem because just keeping all of those different pieces of evidence is just burdensome, and it's a bit of a logistical nightmare. But if you don't keep all of that, then the tax authority might say you need to have VAT on that supply, and that's going to be a cost to you. So what is the actual change that's coming in for this quick fix? Well, it's actually meant to harmonise and simplify the rules for obtaining evidence to support the movement of the goods, and hence you can have the exemption. So the EU have done this by adding a new article to the implementing regulations, and the implementing regulations give more details and guidance to the VAT directive. So they've added in Article 45A, and in 45A, they've added 2 new rules. And I think it's really important just to say that these are presumptions, and we'll talk about what that means in a minute, but they're saying that the requirements to prove that goods have been dispatched to another member state will be met, or presumption will be made, if, in the first case, the supplier indicates the goods have been sent and is in possession of 2 items of non-contradictory evidence issued by 2 different and independent parties. And I'll just go through what the evidence is now. So the evidence would be, for the first part, it would be any documents relating to the dispatch or transport of the goods, such as a signed CMR document, a bill of lading, an air freight invoice. And then the second piece of evidence would be it would be an insurance policy relating to dispatch or bank documents proving payment, any official documents issued by a public authority, or a receipt issued by a warehouse keeper in the member state of destination. And then the second presumption is that if the supplier has a written statement from the acquirer stating that goods have moved, and also 2 pieces of evidence, as I've just mentioned, then the exemption can also be applied. And what's really important about this bit is that if you go for the second option, so the supplier has a written statement from the acquirer, that written statement needs to be received within 10 days following the date, following the end of the month on when the goods actually moved. So quite detailed evidence requirements being laid out by these quick fixes. And so what does this mean for the business? Well, I think the first thing is that it's a presumption, and the law does say that if any of the member states, they may be able to rebut that presumption that's been made under the law. So we might see challenges from tax authorities looking to challenge the point, but it's important that it's not a legislative requirement, it is a presumption, and that's a slight difference in law and how you might go about managing the system. The evidence you need to get, it talks about being clearly independent sources where you gather it from. There's no definition of independent. The documents are unstandardized. So at the moment, it's generally a CMR document and you can get the same things. Now you might have to get lots and lots of different documents, all from different parts of the business. And that's going to be very difficult to maintain as well. So I think it's a big jump from a system that is complicated, but people are on top of it, to a new complicated system that's going to take time to learn. And so that's the last of the quick fixes we're going to talk about. We'll just do a wrap up and questions in a minute. We've just got a quick poll to say. And the question for this one is, having listened to everything that we just talked about, how will your business be preparing to comply with the changes associated with the evidence-based quick fix? So the one that I've just talked about. Were your systems currently sufficient to get all the information? Only minor changes, major changes needed, or you don't get any evidence at all at the moment? So we'll give it just a little bit longer, and then we'll click and see what everybody's said. There we go. So that's good. Again, it looks like from what the feedback is, 75, almost 80% of people think that their systems can gather most of the information that they need. So that's going to be really good. But a few people need some major changes, and some people don't have evidence at all. So I think for those people there's 5 months to go. There's time to start bringing it all together now. Okay, so what I'll do now is just wrap up before we have any questions come along. So hopefully that's been really useful to listen to what's been said there, and there'll be some good steps to go. I think it's obvious from what we've talked about that there are quite significant changes coming along, and what is important to say is that there is lots of conversation about this within the European bit. I was just going to share a quote from the VAT expert group that highlights some of the practical challenges. And this is an extract from a report they published a little while ago. And it said, it's important to remember the starting point for the quick fixes and the objectives of them are a short-term measure to simplify the current system, less burden for business and consistent application of the rules. And they asked the question, do these adopted regulations achieve those objectives? I said, when looking in more detail at what the Council adopted, it feels that the quick fixes are far from being a simplification, but create major complexities and considerable increase in process and formalities. Some might see it as a backward step for businesses, and we hope that a more existing and beneficial simplification regimes can be maintained. To ensure that quick fixes are a real simplification in practice, it's important the Commission clarifies and communicates on unclear points, so there's more legal certainty and a uniform application of the rules is put into place. Now, I think all of that rings true on our view, but what is good news is that the EU have formally responded, and I've heard them say this in person, that they are going to be putting together some guidance that's going to be published in the autumn that will help give some certainty to businesses about how they manage the situation. And that will be really good and really helpful. I think in the short term, what businesses need to do is if they know they're going to be affected by these, start to look at their supply chains that will be impacted, start to look at what the gaps are between the rules that they meet now and the new rules, and then start to find out how they plug any of those gaps. Great. Okay. So we've got a few questions come in. I'm going to hand over to Andy now to answer the first question.
Okay, thanks, Rob. This one is in relation to call-off stock, and it's asking the question that can a supplier from member state 1, so for example Hungary, have 2 customers located in different cities in member state 2, which in this example would be the Czech Republic. So in the member state 2, there would be 2 different warehouses, and the question is, can that still be created as call-off stock? So the customer is known as soon as the goods are dispatched from the premises of the supplier in member state 1. So as Rob mentioned, the VAT expert group has asked lots of questions in relation to this, because the way that the law has been drafted does raise lots of questions. And one of the questions that they dealt with was whether a call-off stock arrangement could exist in relation to several intended acquirers concerning one particular type of bulk good. So this would be where bulk goods are stored in one place, and they're then going to be used for several different customers. And under the current rules, that would normally be seen as a consignment stock rather than a call-off stock. The Commission have said is that would be possible insofar as the expected volume per client that they're going to take out of that bulk goods would be determined at the time of the transport of goods. So my view would be that you could draw a comparison between what the Commission have said in relation to that example and the example that we've just given about the goods going from Hungary to 2 separate warehouses, to say that it would appear that the call-off stock arrangement could apply in that particular example. And just on the call-off stock simplification as well, what the Commission has said is it's not optional. It's not something that you can choose to use as you can under the current system. If you meet the conditions for the simplification to apply, you've got to then apply it. It's only disapplied if you fail to meet one of the conditions. So hopefully that answers that question. There was a further question in relation to call-off stock, which talks about having a PE in Holland, and I'll pass that over to Rob to answer that one.
Great, thanks, Andy. So this question is around having a establishment in Holland and a warehouse there, and stocks being moved from the UK to the Dutch warehouse and then sold there from across Europe. And so how would the quick fix affect this? So this sounds like what we call an own movement of goods. And as it stands, and there's no change to this, if you move your own goods from one member state to another one, it is treated as if it's a supply for VAT purposes. So the answer to the question is that all of the rules that we've talked about all of the quick fixes that we talked about will apply to the own movement of goods. So we need to make sure there's a VAT number in the Netherlands, that the EC sales list is filled in, and that you've got all of the new sets of evidence is provided to people. So I think just treat it in the same way, like I say, and that should stand you in good stead. Okay, so I think that's all the questions that we've got. If there's, oh, hang on, there's one more question just come in here. So this is around the quick fix number 4. So this is, our business holds copies of CMR documentation from freight agents. What would be the second form of independent evidence? What would be the second form of independent evidence required? So I'm just going to turn to my notes because it is complicated. I'm going to double check to give you the right answer. So you've got evidence of the CMR. The other evidence you would need to get, so if you got, if you were the one making a presumption and indicating goods have been pushed, you'd have to have a CMR document, and then you could also have a bill of lading, an air freight invoice, or an invoice from the carrier of the goods. Now, I guess what would be interesting about this one is that you would have to get, they'd have to be issued by 2 different parties. So if the freight agent is the one giving you the CMR, then you have to go to a different party to give you the bill of lading, an air freight invoice, or an invoice from the carrier of the goods. And that's where it might be complicated. I guess the other thing to think about is that also independent question, as we alluded to, what if you have a group company that is also the freight forwarding company within the group? Is that independent or not? The independent question has been raised with the EU, and it is hopefully going to be included in the guidance that we get later. So we should be seeing that. Great. Okay, there's no more questions come up, so hopefully that's answered everyone's questions. If you do have any thoughts about it later, then please drop your normal Accordance contact line and we'll come back to you separately. Otherwise, thank you very much for everybody listening, and enjoy the rest of what is a very hot day in Brighton, and I hope across the rest of the UK and Europe. Many thanks. Bye.